Hey there! Welcome back to Bull and Bill. If this is not a welcome back, make it by clicking the subscribe button. Today, we're tackling a big question that's on everyone's mind during turbulent market times. How long do market crashes last? If you've ever watched your portfolio take a nosedive, you know that feeling, the panic, the uncertainty, the urge to act. But here's the thing. Market crashes are not the end of the road. They're a natural part of investing, and understanding them is the key to surviving and thriving through them. In this video, we'll cover everything you need to know, from the historical patterns of market crashes to what causes them, and how you can navigate them successfully. By the end, you'll not only feel more confident, but also be better equipped to make smart decisions when the next crash inevitably comes. Let's dive in. First, let's define what we're talking about. A market crash isn't just a bad day on Wall Street, it's a sharp and sudden decline in stock prices, typically 20% or more, often sparked by economic crises, investor panic, or unexpected global events. Crashes are the more dramatic cousins of corrections, which are smaller declines, about 10% from a market high. While corrections happen roughly every 1.5 years, crashes are less frequent but much more impactful. Think of corrections as the market catching its breath, and crashes as a full-blown sprint to the bottom. So, why do crashes happen? There are usually three big triggers: economic weakness, slow growth, rising unemployment, or declining consumer confidence can shake the market. Overvaluation: when stocks are priced far above their actual worth, they're ripe for a correction, or worse, external shocks. Events like wars, pandemics, or sudden policy changes can send markets into a tailspin. Now let's take a trip through history. How long have crashes lasted in the past? What can we learn from them? Here are some of the most notable market crashes and their recovery times. 1929, the Great Depression. This was the longest and most severe market crash in U.S. history. It took the Dow 25 years to regain its previous highs. The main culprits? Overspeculation, a lack of financial regulations, and policy missteps. 1987, Black Monday. The market dropped 22% in a single day, but surprisingly recovery was fast, just under 2 years. Why? The economy's fundamentals were still strong and confidence rebounded quickly. 2000, the dot-com bubble overvaluation in tech stocks led to a 6-year recovery for the Nasdaq. It's a classic example of what happens when speculative bubbles burst. 2008, the global financial crisis. Triggered by subprime mortgages and a near collapse of the banking sector, this crash took nearly 4 years for the S&P 500 to recover. 2020, the COVID-19 crash. This was unprecedented in its speed and severity, with markets falling nearly 34% in weeks. But thanks to aggressive policy measures, it rebounded in just 5 months. On average, market crashes last between 6 months and 2 years. But as you can see, the specific timeline depends on the root causes and the response. Why do some crashes last longer than others? It boils down to a few key factors. Economic fundamentals. Stronger economies recover faster. In 2008, systemic financial issues prolonged the downturn. In 2020, however, the underlying economy was more stable, allowing for a quicker recovery. Government and central bank actions. Policy responses can make or break recovery timelines. For example, during COVID-19, central banks slashed interest rates and launched massive stimulus packages, spurring a rapid rebound. Investor sentiment. Fear can prolong a crash, while optimism can speed up recovery. Studies show that markets often see their best days right after their worst. Here's a statistic to think about. If you missed just the 10 best days of market performance during any 20-year period, your overall returns would be significantly lower. Staying invested, even during a crash, is often the smartest move. Let's take a closer look at the 2008 financial crisis. What made it so severe? And what can we learn from it? The cause. The housing bubble burst, leading to widespread defaults on subprime mortgages. This in turn triggered a global financial meltdown. The recovery. It took nearly 4 years for the S&P 500 to recover its losses. Why so long? The crisis exposed deep flaws in the financial system, requiring significant reforms and bailouts. The lesson: diversification matters. Those who spread their investments across different asset classes weathered the storm better than those who were overexposed to housing or financial stocks. So, what can you do when the market takes a dive? Here are some actionable strategies. Stay calm. Emotional decisions often lead to losses. Remember, crashes are temporary. Diversify your portfolio. A mix of stocks, bonds, and other assets can reduce risk. Keep investing. If you're financially able, crashes can be an opportunity to buy quality stocks at a discount. Focus on the long term. Over decades, even the biggest crashes become mere blips on the radar. And if you're really struggling with the emotional side of investing, consider working with a financial advisor. They can help you stick to your plan and avoid costly mistakes. Let's clear up a few common myths. Myth number 1. Crashes mean the market is broken. Fact: crashes are a natural part of the market cycle. They often correct excesses and pave the way for future growth. Myth number 2. Timing the market is the best strategy. Fact: studies show that time in the market beats timing the market. Myth number 3. You should always sell during a crash. Fact: selling locks in losses. Staying invested is the key to recovery. So, what's the big takeaway? Market crashes are inevitable, but they're also temporary. History shows us that recovery is not just possible, it's likely. The key is to stay informed, stay diversified, and stay invested. Thanks for spending time with us here at Bull and Bill. If you found this video helpful, don't forget to like, comment, and subscribe. We're here to guide you through the ups and downs of investing, one video at a time. Until next time, stay patient, stay optimistic, and keep building your future.